Hello, everyone. Welcome to Basic Trading Episode 2, where we're going to talk about my trading flywheel. And that concept may or may not be familiar with you, what a flywheel is. And that's okay. You don't have to know what this is. We're going to talk a little bit about it. But the basic idea today is that we're going to go and look at what my operation looks like at a 30,000 foot view. And hopefully by the end of it, you can look at my operation and maybe take some elements and build your own operation. Or maybe you take the whole thing and use it the same way that I do, and that's perfectly fine as well. Or you can figure out something else on your own that may make more sense to you. It really doesn't matter, but I'd like to zoom out a little bit and talk a little bit from a higher perspective, how I operate. And I think that might be instructive for many of you. Before we begin the presentation, I just want to remind you that this presentation is not financial advice, and I'm not a financial advisor. So everything I talk about here is, hopefully to your benefit. But again, take it the way that you take whatever you can from it. But understand that this works for me. It may not work for you, and you need to find your own way and find what works best for you. All right. So there are three aspects of this trading flywheel. There are three phases you can think of them as. There's the cash generation phase, there's the growth phase, and then there's the assets phase. The cash phase is essentially generating cash through day trading and short-term swing trading. The growth phase is compounding the cash that you generate over time and growing that with longer term swing trading and potentially position trading. And then that capital is going to flow into assets where you're going to buy appreciating assets. That could be things like businesses or investments or your savings account. Of course, saving money for taxes and things like that you need to pay for. And whatever else you decide that is a valuable asset for you. And of course, some of this is going to flow out of this flywheel and into accounts that you may use for paying for experiences or paying for things that you need. And that's perfectly fine, but we won't talk about that. You can, balance it however you want or rebalance it however you want at the end. So those are the three phases. Let's dive in. This is going to be a relatively short video. We're not going to have to dive into too much of the detail today, but I think it'll be helpful for you to kind of see as a visual what this operation looks like. So here's the trading flywheel. Here's essentially the flywheel that I've been using for a while. I've added elements to it over the years. In the past, I did not day trade. Before 2020, it was all swing and position trading for me and investments. So there's new elements to this that I've added over in recent times. But essentially, the basic premise of it has existed in my mind and in my operation for 20 something years. So I think it works. I think it's pretty straightforward. I think probably there's a lot of people out there that use something very similar, if not exactly the same. I think it's a pretty common sense approach to managing capital and having it flow through and compounding over time. Now, again, I want to remind you, you don't have to do every phase here, right? There's some people here who are going to be listening and that absolutely don't want to day trade, and that's okay. And there's going to be some people in here that absolutely don't want to swing trade. There's going to be people in here who never want to trade stocks ever again or buy stocks ever again. They only want to trade options, and that's perfectly fine too. There's going to be people in here that don't want to buy real estate, and that's all right as well. So again, this is from my perspective, and you can take what you like, take what you don't like, and hopefully by the end of this next few minutes, you'll have a high level understanding of what my operation looks like, and then you can build your own and go from there. But we're going to dive in depth into each of these areas over the next coming months as more episodes come out. We're going to dive really tactically into day trading and swing trading. We'll expand upon all the videos that we've had in the past around those topics. But my goal is to do it in a slightly more linear fashion as opposed to you guys having to jump around videos. That being said, past videos are super important still. I would definitely watch them if you haven't. All right, so let's talk a little bit about phase one. So this cash generation phase. So this is going to be, your day trading. This is going to be, day trading your favorite stocks, maybe SPY, SPX, options, QQQ, IWM. It could be a day trading commons, and it's directionless, right? You can trade up, you can trade down. It's also, your swing trading, right? It could be, options trades, it could be commons trades, short term. This is going to be short term swing trading. So we're thinking in terms of, days to maybe a week or two, not really long term swings that we're taking, which we'll use instead for growth. This could be, end of day SPX. I know there's a lot of folks that follow me that like to trade end of day SPX. That fits within this cash generation phase of the flywheel. And so as we're generating cash, and again, when you're starting out small, maybe you're initially going to start in the cash generation phase, and then over time you'll make your way to growth, or maybe you don't have a cash generation phase and your cash generation phase is simply position trading, right? That's perfectly fine too. But over time, you're going to start to see that there may be a necessity to sort of differentiate these things, as I've seen. Generally for day trading and short-term swing trading, I'm not willing to put as big of size on it, and that's by design, right? The idea here is to generate cash. The idea here is to compound that cash over time. So as we generate cash, that cash generation flows to growth, and these are going to be balanced. You can have some sort of balancing percentages. You can do, however you want to do it. There may be just certain amounts that you want to keep. Maybe you're only keep a certain fixed amount of money in your cash generating accounts. Maybe you only keep a certain fixed amount in your growth generating accounts, and then maybe everything else flows back to assets, and that's perfectly fine. So as we generate cash, we're going to flow into growth, and growth is going to be your longer term swing trading. We're talking about a couple, few weeks to months, position trading where you're holding something for a decent amount of time, but it's not a long term investment where it's you're buying something and you want to hold it for decades, let's say, or however long you can. This is going to be like, hey, I'm going to buy a stock and I think it's going to go to this price, and I'm going to sell it or I'm just going to hold it until it feels like I need to get rid of it, and you're going to take profits on it. And so the idea here with swing trading, longer term swing trading, whether that's on commons or options, or position trading, which could also include leaps as well. The idea here is that you might be willing to take bigger size on things, but you have somewhat de-risked the trade because you're giving yourself more time. Hopefully you're taking fewer of these type trades, and they're just meatier trades. I think of buying Nvidia, the weekly inverse head and shoulders, in 2023. Think about people who bought Tesla in the 2020, right? People who bought Apple in the 2010s, like me. That was like a major thing. That was probably the biggest cycle of growth that I had, was just swing trading and position trading Apple back last decade. And then that capital is going to be generated, and being able to put bigger size on it means that the returns from a dollar perspective are going to be bigger than what you're going to be able to generate in the cash phase. And it should hopefully be a little more hands off. You don't really need to spend as much time, but you do need more time for it, and that's the benefit, right? You're giving you're putting in capital, you're putting in time, but you're getting bigger growth, and you're not having to spend as much time on it. Now, as you're generating capital in this growth phase, that growth is going to flow into assets, right? This is where now, after you've generated cash and you've grown that cash, you can start to buy investments. Of course, you have to pay taxes, so don't forget about that part too. That's included in the assets side. But maybe you're trying to, maybe every once in a while you take off and you buy some VOO, or you buy some SPY, or you buy some QQQ, or your favorite stock, Apple, Nvidia, Tesla, whatever it is, right? Or maybe you're investing in a startup, or you're investing in, whatever it might be, or maybe you're starting your own small business. That's the idea here. You're putting it into potentially appreciating assets and investments that could also be cash generating as well. well. Things like real estate, of course, savings, bonds, all that stuff, right? That's all included in this assets phase. This is a very broad phase. It's probably going to be very personal depending on what you like to buy. It could be, whatever it is that you find is a valuable asset to you that you think will appreciate over time. The idea is to start to outflow some of this capital from the cash and growth generation into assets that can work for you while you're sleeping. And then, as you're generating cash, as you're growing cash, as you're building assets, all of these things are going to start to go up. And over time, you can rebalance as your net worth grows. Maybe your cash accounts start to get bigger. That's fine. Maybe your growth accounts start to get bigger. That's fine. You can do it however you want. And then, over time, it'll continue to work and continue to work. And as long as you're maintaining good risk management, which of course we talked in episode 1, and you've managed yourself and you've built an operation that is functional, as your net worth grows, each of these phases should create more and more capital over time. Cash generation phase, maybe you may keep that fixed, but the growth generation phase certainly over time should create more capital, right? And the assets as well. As you start to invest in more assets, assuming that they're good ones, that should also start to build on itself and continue to grow. So that's why it's a flywheel, right? It keeps going. You're building cash, you're growing cash, you're buying assets. Those are producing capital, producing equity, whatever it might be. That's rebalancing back. You now have a bigger account, you're growing it and buying more assets, et cetera, over time. And then hopefully, at some point you get to the point where you're happy with the amount of capital that you have and everything's working for you and you're all set to go. So that is the 30,000 foot view of what what my operation basically looks like. Now, I should qualify with the fact that I don't position trade nearly as much as I used to. I've had some recent ones like IWM and NVIDIA, and in the past, I've had a lot of Apple position trades, but I don't do that nearly as much as I used to. Now it's really much more day trading and swing trading for me. But certainly, everybody's got their own speed and their own process for doing things. So certainly you can manage it the way that you like to manage it. Okay. So again, let's just zoom out one more time. We'll talk about it one last time, and then I'll let you go on your way, and I want you to digest this and start to think about this and how it might work for you. So we've got the cash generation phase. That's going to flow into growth. Growth generation phase is going to flow into assets. The assets are going to grow over time. You're going to rebalance as your net worth grows, and it just is going to continue to work in a perpetual machine. Now, the thing that makes this work, again, from episode 1 is you, right? Now, if you go on tilt, everything's going well in the cash generation, make a bunch of money. Now, all of a sudden, you just go on tilt and start buying random things in the growth phase. This is going to go to zero, and all of a sudden, the whole flywheel stops. So it's very important at each one of these phases and each one of these stages to remember that the most important thing that you need to do is manage yourself and, of course, manage your risk. Otherwise, this flywheel will come to a screeching halt very, very quickly and could put you in a potential financial ruin, which is, of course, not what you want. So that's the trading flywheel. I want you guys to think about this as we start to move into additional episodes. In the upcoming episodes, we're going to get very tactical about day trading and swing trading. And of course, we'll get into a little bit of the details around swing trading and position trading. This is really going to be mostly focused on the squeeze and longer term setups. This is going to be focused on all the near term setups that we trade, the VAMI, the phase oscillator divergences, continuation trades, basic flags, and things like that. And then assets, I won't really go over that. That's going to be something that you guys have to do on your own. And of course, there's tons of material, there's tons of material out there that you can look at to figure out what it's too broad. It's not something that I can really go into tactically for you guys. One more thing that, I think might be useful is when you think of these two phases, I really do think it's beneficial to have separate accounts. In fact, I think it's actually good to have a separate day trading account, a separate short-term swing trading account, a separate long-term swing. I think the longer-term swing count and position count probably can be both in the same, but these two probably should be separated out, and this should be its own thing. That keeps it separate. Also, when you may have a bad day trading, you're not looking at your position trades and freaking out, or your swing trades and freaking out, and you may have a bad day on the market for your particular trade on a swing or a position, and having it in your day trading account may mess up your psychology for the day trades. So I do think having separate accounts in some fashion is probably a good idea. Of course, you can handle that however you want. Maybe it's separate watch lists within the same account, but I think it's beneficial to really just separate those P&Ls out so that you can kind of get a sense of how things are flowing. So that's kind of how I would put it. Now, these two can be in the same account as well. You can have day trades and short-term swing trades, and then you can do, longer-term swing trades and position trades in a separate account. And then I would say, a third account to hold investments, things that you just don't want to touch. You're just continuously adding to things that you want to hold for a very long time that you're not really looking at very regularly. You're just kind of checking in on them every once in a while. So I think you should now spend some time thinking about this. Maybe look at this flywheel for a little while. Think about how it relates to your current trading. Think about how you might be able to adapt it to the way that you want to trade. And then we will start to go in and be very tactical about this over the upcoming episodes. I hope this helps you guys. I hope you now have kind of a high level 30,000 foot view of kind of how my operation works. And I hope you're able to construct something that works well for you. And think about that as we start to dive into each of these areas and start to get better at them. All right. And with that, I will leave you all. I hope you have a great day, and I will see you in the next episode.